Hello, everyone. Good afternoon. It's great to have Jay with us again. He's taking the time to do this, in a holiday, so we really appreciate. So, another, difficult week, and Jay made an interesting analogy, to a Bruce Lee movie, which he's a fan, and talking about the Hall of Mirrors, and it looks like the Fed is in the Hall of Mirrors. So. Jay, welcome, and let us know, what you mean by that.
Sure, Roberto, great to be with you, even on a holiday here in the U.S. The title of the Musings on Friday, Hall of Mirrors, refers to a fight scene in Bruce Lee's epic movie Enter the Dragon, where he fights his adversary in a hall of mirrors, a room that's completely mirrored. And so it seems as if there are multiple enemies as opposed to a single enemy. And it struck me that that's a pretty good analogy to the markets after the last couple of weeks. When you think about the fact that the S&P was down 6 of the last 7 days going into Friday when I was writing, that it's down 10 of the last 11 weeks, or perhaps most extraordinary, the 5 of the last 7 trading days up until last Friday, the S&P had 90% down days, meaning that 90% of the stocks that make up the S&P 500 were down on 5 of those 7 trading days, which has never happened before. So
100 years, right?
Yeah, in the last 100 years, it's never happened before. So, I mean, we're really talking about unprecedented selling, unprecedented volatility. And I think it reflects the fact that, we saw the Fed tighten, raised by 75 basis points for the first time in 30 years, and tighten into a bear market for the S&P, which, again, it has never done. Through all the tightening cycles, the Fed has never tightened when the S&P was in bear market territory until last week. So a hall of mirrors, I think, captured the environment that we're dealing with as investors pretty well.
Yeah, and so the take now. I mean, we normally like to do with the traditional methodology, using the climate, and all and macro policies. But what do you think that means? Especially for the economy. And you mentioned a nice statistic, saying that now JP Morgan thinks that 90%. It is. There's a 90% implied probability that the U.S. and Europe will go into recession. So, I mean, what do you think is priced in, and what's not priced at this stage?
Well, yeah, the JP Morgan work reflects that on a typical bear market, the S&P is down X%, and today it's down X minus a few. And so that tells them that 90% likelihood of a recession is already priced into the S&P and into the European broad stock market. So, I mean, to me, what's really interesting, Roberto, is these gaps between sentiment and reality that are really manifesting themselves in the U.S. and I think broadly elsewhere as well. And let me just give the audience 2 or 3 examples of what I mean. The first that really jumps out, and people have probably seen it in a bunch of charts, is the tremendous gap between consumer sentiment in the United States, which is at an all-time low. So think about what that means. The University of Michigan Consumer Sentiment Survey, Consumer Confidence Survey, is at an all-time low. So that means consumer confidence in the U.S. today is worse than it was in the Great Financial Crisis, worse than it was at the bottom of the tech bust in 2001, 2002, worse than it was in 9/11, worse than it was in 1987 with Black Monday. So clearly, consumer sentiment in the United States is deeply depressed, but that's their sentiment. The reality is that unemployment is at near record lows, and consumer spending and consumption continues to be quite robust. Pantheon Economics, which is a group I think does a pretty good job, they're still forecasting close to 3% real consumption growth in Q2. And so there's this gap between horrible consumer confidence and the reality of consumers still spending. Another example was in the small business small business confidence surveys, where again, small business confidence at an all-time low. But then when you look at small business expectations of hiring, it's still elevated. So they still expect to hire more people, even though their confidence level is at an all-time low. And then the third is big corporate CEO confidence also declining sharply, and yet insider buying is the best it's been on a relative basis. So insider buying versus insider selling, it's the highest it's been. That ratio is the highest it's been since the lows of COVID in March of 2000. So you hear all these CEOs getting up and talking about how things are bad and they're really worried, but yet insider buying, which is the people typically in the C-suite, has been better than it's been since the low of 2020. So there's all these gaps between kind of where sentiment is and where reality is, and even in the stock market, investor sentiment clearly at close to all-time lows. You look at the Bank of America Bull Bear survey that they have, their little needle that they show. It's at zero. It's only been at zero like 3 or 4 times. So it can't get more negative on sentiment than zero, right? At least in their model. So and yet earnings, if you look at earnings expectations, continue to be gradually ratcheted up. So we'll see if Q2 is the beginning of what so many people seem to expect, which is a big drop in earnings as analysts have to cut their numbers. We'll see. I think that's going to be a big focus in Q2 earnings season, is not only Q2 earnings, but the outlook for the second half of the year.
That's actually more important. I mean,
yeah, the outlook for the middle of the year. But usually it is more important. But in this instance, when people already think we're in recession, if earnings growth comes in relatively robust, that would suggest that, A, we're not already in a recession, and B, companies are able to pass along some of the input price increases. And this gets back to the nominal growth environment, that you and I have talked about quite regularly over the last couple of months, in which we think at TPW Advisory is a real differentiator from prior periods, that we are in a high nominal growth environment, and therefore companies have more flexibility on the pricing, which should support their earnings, and which is one of the reasons why we think at least analysts have not yet chopped their earnings estimates, because companies are telling them that they're able to pass through price increases. And so we'll see what happens as we go forward. But I think these differences between sentiment and reality are important. And they even kind of, I think maybe the next subject we can tackle is kind of how the Fed is dealing with this. And, the Fed may have its own hall of mirrors to deal with. I mean, should we talk a little bit about the Fed, or?
Yeah. Let's talk about the Fed. So because I thought we were going to pause when you were drinking water. What I was going to ask is, just to conclude on that point, do you think the asymmetry is positive, right? From this earnings season, right? Because maybe too much bad stuff is already priced in. So is that your sentiment?
Well, I mean, it's not so much my sentiment as it's just the reality, right? I mean, JP Morgan and others have pointed out that
90%.
The percentage, well, not even that, but the percentage of, earnings upgrades versus downgrades has been increasing over the last several months. Increasing, not decreasing. In other words, more analysts are raising estimates than cutting estimates. That flies completely against the general tone of things. And look, again, you were an analyst. I was a strategist at a big firm. Analysts are the ones closest to the companies. It doesn't mean they always get it right, but those are the people who are talking to the companies with their models
every day,
and understand, how the models work to spit out the data at the end of the day. And so, certainly I think people are, I mean, if you're bearish at these levels, because we've already adjusted the price, right? We've had a valuation re-rating, right? S&P, NASDAQ, pretty much every region of the world is now selling, at below their 5 and 10-year average multiples. Even the S&P is below its 10-year and 5-year multiple at this point in time. The NASDAQ is much cheaper. The innovation stuff has completely derated. And so now the question is to argue that we're going to get another leg down, another 10 or 15% down, which many people feel is quite possible. You need to see earnings come down. That's going to be what brings us down. It's not going to be, it's unlikely to be another significant derating on the P front, on the price front. It's going to be earnings having to get chopped because we're in a recession, and that's what's going to bring stocks down another 10 or 15%. So, I mean, it remains to be seen. But again, I am more on the side that says in a high nominal growth environment, companies have pricing power, and for the majority of companies, earnings are going to be pretty close to where they are at the moment. So if you're at, I think the consensus for earnings is around 225, 230 for this year, 245, 250 for next year. If you're going to take a 15% cut on that, then you come down to $200, right, as opposed to, or 210 or something like that for this year. And that's how you get to another 10 or 15% down in the market. But to me, I will err on the side, at least at this point, of a high nominal growth environment being more supportive of earnings than folks of a more bearish tilt would think. Let's put it that way.
Yeah, and we've run through. I mean, you've run through the math last time, which is normally without EPS downgrades.
We're there.
And it's we're past there because we had 25% correction, 26. I don't know.
Yeah, 22 on the S&P, 30%.
Yeah, 22 on the S&P.
30% on NASDAQ.
And if we get EPS cuts, then the number would go to 35%. So that's exactly the math. One can argue, okay, now we're coming off a higher base, and there's everything bubble and blah blah blah. So it can be more, but who knows? Nobody knows, right?
Well, I mean, that's one of the points that I mentioned in the musings, that this idea in the media that we're just now getting to the point. Like I referred to a headline in Friday's New York Times, "Welcome to the end of the everything bubble." And I was like, really? I mean, the innovation stuff peaked in Q1 of 2021. Yeah. So 15 months ago. It's been in a 15, 16-month bear market with stuff down 70, 80%. The SPACs have been completely destroyed. The meme stocks completely destroyed. Crypto completely destroyed. So the idea that on Friday of last week, the Times puts in a headline I'm not sure it was a front page headline, but a headline, "Welcome to the end of the everything bubble." I mean, it's already, the bubble burst ages ago. And so the index, particularly on NASDAQ, was held up by the FANG stocks, and they have now corrected aggressively. 30%, NASDAQ is down 30% from its high. So I think, sentiment is in some ways ahead of things, and in other ways way behind. So it's just makes for again, this challenging environment for us as investors and prognosticators on markets. And even the Fed, just to finish that point we started a minute ago, the Fed might be in its own hall of mirrors. I mean, because its commentary last week and Chair Powell's commentary, was very different, right? I mean, they had assured us practically that we were going to get 50 basis points in June, 50 basis points in July. Lo and behold, the May inflation number comes out. It's slightly worse than expected, only 2 or 3/10 worse than expected. And yet the Fed immediately swung to 75 basis points. The Fed has been telling us to focus on core. And then last week, all the talk was on headline inflation. I think that reflects the political impact of these rising gas prices and rising energy prices and food prices, the political structure in the
Yeah.
US and in Europe, as we were talking about before we went live, is definitely feeling the pressure. And so the Fed is now feeling that pressure a little bit. So all of a sudden, we're talking about headline inflation. There was a focus on growth being strong. The Chair Powell even said the economy is strong. It should be strong enough to handle these rate hikes. And then they cut their growth estimate for 2022 from 2.8% to 1.7%. I mean, that's a swinging cut for the Fed. And they also cut 2023 from 2.3 or so to 1.7. So the Fed has really kind of changed its tune. And now we'll see kind of where we are. But I think maybe to preface our next subject, I really think the focus should be on the energy front at this point.
Yeah. And can we make the case, because I've seen some people say that, without any reduction in oil prices, in energy, overall, it looks like, the Fed, is fighting a war with a water pistol, because they, because they have to cause a big recession, and then, all the story with all the consequences. And last week, I think you saw, the ECB, had basically to do an emergency meeting to do with fragmentation, to put a cap on spreads. So now we're starting to see, these, second order effects everywhere. So is that really the case? I mean, the central banks have a water, without, any major correction in commodity prices, basically energy, they're basically fighting a war with a water pistol.
Well, I mean, this is what I think the Chair Powell opened himself up to when he all of a sudden switched the focus from core to headline, because the headline is much more involved. Core is X energy, X food. Headline includes those two. So now, yes, the Fed has brought that discussion right upon itself with its own commentary. And so I think there is this concern about, the Fed is raising rates. We've had, certainly in terms of the rate of change interest rate structure in the United States, whether it's the Treasury market or the mortgage market, we've had an almost unprecedented tightening, right? Because rates have shot up so aggressively, so quickly. All right. The Fed, like the ECB, is following the market, right? The bond market has really been in charge, okay? Because they are moving rates much faster than the central banks. And the equity markets are following the bond markets. And that's why we've had the valuation derating, because that's how it works. When rates go up, long-dated assets valued off of cash flows over time, their multiples must come down. We've had that, okay? So that's why we talked about before. The next step is the earnings. The earnings hold the key. But for the Fed, I now think we've switched our focus, or we've certainly sharpened our focus to the energy space, and in particular, the gasoline price in the United States, because that is where people's attention has gone, in part because the Fed said, hey, we're now focused on headline, which means you and me and everybody else trying to figure out the markets needs to focus on the headline. That means gasoline prices. That's the most visible. And what's interesting is, again, this sentiment versus reality. Sentiment is gas prices are going to the moon. Everybody's complaining about how much it costs to fill up their tank. I am a good urban citizen and live in New York City. I don't even have a car. I don't even own a car, right? I get around mostly by bicycle. So that's not really my issue. But in all seriousness, the point is that gas prices in the U.S., wholesale gas prices, future prices, have already looked like they've peaked. Believe it or not, they're down, as of today, 12% from the peak several weeks ago. Now, typically, I was with some folks this morning on another video session with some experts who trade in the past, have traded gas futures. And here's how they explained it to me. Typically, there's a 70% or 70 cents difference between wholesale and retail. So wholesale is now $3.80. You add 70 cents, that's $4.50. Gas today is, depending on the day, is $5, $5.05. Arguably, it should be coming back towards that $4.50. Typically, the time frame for that to occur is anywhere from 2 to 4 weeks, because obviously when the guys at the pump in the gas station have a full underground tank of gasoline, they're going to sell it at that high price until they can no longer sell it at that high price. So it's a little sticky for prices to come down, if you follow what I'm saying. So the other thing that I thought was really interesting is that seasonally, gas prices peak in the United States towards the end of July, right? Because the driving season is Memorial Day, beginning of June, to Labor Day, end of August, beginning of September. But everything moves, a little bit ahead. And so
anticipation, people, they're buying anticipation.
That seasonality is 30 years worth of data. 30 years of data. Gas prices in the US, they tend to peak towards the end of July. Here, we may already have had the peak because of how quickly things have run up. There's no real sign yet of demand destruction. In other words, driving this past weekend was ahead of driving last weekend, was ahead about 7-8% of driving a year ago. So there's no real signs yet of demand destruction, but there are signs that gas at the wholesale level has already peaked. And that suggests that within the next several weeks, we could see prices starting to decline in the retail level, which is where the CPI, obviously the input into the CPI comes from. And it may simply be that refiners who are making all sorts of money. I mean, a statistic I put in the Musings on Friday was that the average crack spread, so the spread between, when you get a barrel of oil in the refinery, you break it into different parts, diesel, jet fuel, gasoline. Typically, that crack spread is the term, is $10. Again, going back the last 20 years, average $10. Today, it's $60, 6 times the average. So obviously for the refineries, they want to get they want to put through as much oil as possible so that they can capture that spread, which is unparalleled. And that could be what's leading to gasoline prices rolling over, because the refineries are pushing out so much gas. So again, and it makes perfect sense. Just when we're getting all freaked out, just when the Fed is like demonstrating this huge sense of urgency in this inflation fighting, we're going to get inflation down to 2%. We could be just on the cusp of gas prices rolling over, which I think the market will certainly see as a signal that perhaps the Fed doesn't have to really jam, rate hikes in there to try and deal with this water pistol issue, is the way you put it, which is really good, because the traditional areas of the economy that are affected by rate hikes, housing, labor, price of labor, etc., those are already manifesting signs of being affected by the increase in rates, right? Housing has clearly rolled over. Mortgage applications are down, I think, 25% in the last couple weeks because mortgages have gone up. I mean, forget about Fed funds rate. Mortgages have gone up by 250 to 300 basis points year to date in the United States. The labor market, while still strong, likewise is clearly rolling over. We're averaging 400,000 new jobs a month. Several months ago at the turn of the year, we were averaging close to 1 million new jobs a month. So clearly, job market is softening. If you look at average hourly earnings on a real basis, effectively flat. No real sign of an increase there. So the traditional areas are being, affected by the rate hikes and the market front running the Fed and jamming up rates on the 2-year, for example, from 50 basis points in the fall of last year to almost 3.5 percentage points a couple weeks ago. So I think, it's typical bear market behavior, right? Get everybody all super freaked out, and then boom, pull the rug, and all of a sudden, gas prices roll over, rates roll over, Fed, massive tightenings get repriced out of the market, and we have a potential significant stock market rally off these very, very oversold conditions.
That's exactly what I was going to ask, because if you can, imagine that I mean, oil is already back at 110. So if for whatever reason, oil is I don't know, a few weeks from now or a month from now, below 100. For whatever reason, if Biden gets something out of Saudi Arabia, it really, I mean, although it looks like they don't have that much of excess capacity. But then if you have, if you're right, what you're saying about, gasoline prices, that could be a significant move up, especially if that's coupled with a positive surprise on the next CPI print, correct?
Well, that's kind of what I speculated about in the musings. Well, will the market move on just the gas prices rolling over, or is it going to want to wait and get confirmation from a couple of specific inflation prints, right? June's inflation print, I think, comes on July 16th. The Fed meets on July 27th, 28th. It's right at the end of the month, so it is a ways away. In the interim, we're going to have earnings, which will give us some good color on how companies are dealing with this environment. And I think you make a very valid point. I mean, for all the talk about Russia cutting gas and issues around concerns about oil availability, Brent has not come close to the peak it hit back in March, right?
135, right?
Brent peaked at 135. Even with the natural gas prices in Europe, if you look at the Dutch natural gas contract, which is considered to be kind of the broad bellwether for broad Europe, your benchmark, exactly. It peaked, it's down 40% or more from its peak in early March, even with the increases in the last week or two. I mean, headline writers, like to talk about, wow, European natural gas up 30% last week. They don't tell you that it's still down 40% or 45% from the spike peak. And so, yes, it's up dramatically from a year ago, absolutely. But the system is having time to work through and adjust so that those spike peaks, typically when you spike, you come back down fast. We've seen that. And typically you don't go back up to those spikes, because those spikes are, more episodic and kind of reactionary, knee-jerk, as opposed to anything that's kind of formally thought out. And in the interim, the market has taken steps to rebalance itself, whether Russia being able to, finagle oil exports through different ways, whether it's Saudi and others pumping more, whether it's an increased reliance on coal, as it seems like it might happen in a few European countries, which is not great for the environment. But if it's for 6 months or 9 months to get us through this period and wean Europe off of Russian gas, that's probably a trade many of us will accept. And then ultimately it does push us much further down the road on the clean energy focus for Europe especially, but also for the US. I mean, there's even talk now, and it might just be talk, but there's even talk now in the US of another shot at trying to get some form of Build Back Better passed in the United States here before the midterms. I mean, that seems to me like a stretch, but there is talk of it, and the Democrats certainly need some victories, and maybe who knows, maybe after giving it up as dead, it comes back in some form that reinforces the clean energy thrust. And by the way, it's interesting to note in our TPW20 thematic model, we're seeing that the climate related ETFs, the climate theme is the one that's holding up pretty well. And I think it's in part because with $5 gas, people are going to buy every electric vehicle they can find, with the issue being Russia cutting off gas little by little. The impetus to free oneself from that reliance becomes greater and greater. So I think we're going to see probably this year, next year, continued significant funding of clean energy projects, not only in the U.S. but in Europe as well.
Yeah. Maybe, I don't know if that's a way to look for good news, but can we shift to China? Because as you mentioned, in the musings, you're looking at some outperformance. You finally, maybe because the U.S. and Europe are down so much, but China. Did we find a bottom in China, or and there was also the speculation. I don't know if we talked about the Ant Financial's IPO. Is that going to happen or no? But it looks like things are getting better in China. Is that the view?
That is our view. We had a view of China 2022 glide path that we espoused at the end of last year, looking into 2022. Clearly it's been anything but a glide path, with COVID really becoming a major hindrance for China, as well as the Russian invasion becoming somewhat problematic on the economic front in terms of import prices for things. But on the whole, yes, it would seem to us that China has bottomed from an equity market perspective. KWEB, for example, which is the China tech ETF, which we hold in our global multi-asset model, it bottomed back in March, and it hasn't come close to those levels since March. And it's massively outperformed NASDAQ. NASDAQ just hit a new low last Thursday.
Yeah.
Okay, so KWEB bottomed in March and has not followed the NASDAQ down. And instead, it's NASDAQ like this, KWEB like this. It's outperforming significantly. And a lot of that is the regulatory issues have been shelved, right? Because again, even President Xi in China, they're somewhat pragmatic, right? So zero COVID, they were not going to move off that. That obviously dampened economic activity. That led to the decision, okay, let's take our foot off the private sector a little bit. Let's let the private sector breathe so that we can use it to generate economic activity and have some shot at meeting our targets. And so the KWEB was the immediate response to that. And then I think you're going to see continued fiscal stimulus. We've talked a lot about how the non-US policy mix is much better than the US policy mix, right? US has tight fiscal. In other words, the fiscal deficit is collapsing in the US.
Mm-hmm.
It is tight monetary, right? We have the Fed raising 75 basis points at a clip. And you think about the contrast with Europe and Asia. In Europe, loose fiscal, right? The Next Gen program continuing to pump money into the European governments for the next couple of years. You have the ECB gradually moving to tighten, but certainly not going to be anywhere near as aggressive as the Fed. You have Bank of Japan, and Japan also, making it very clear they're not going to move off yield curve control. They have the capacity to maintain that, I believe, and they're going to continue to maintain that. And the Japanese government is also continuing to provide fiscal stimulus. Then you look at China. China PBOC has every potential to lower rates, right? To support monetary policy, to support the economy. Inflation in China, they don't have an inflation issue. Arguably, Japan doesn't have one either. The inflation issue is really concentrated in the US and in Europe. China inflation is running at about 2% per annum. Same in Japan. So there's room for PBOC in China to cut. And they continue to provide fiscal support. And if you look at the most recent total social financing, the TSF, which is the data that most people look at to get a better grasp of all the liquidity that's moving in China, that number continues to be pretty robust. And so you have policy supportive, you have regulatory issues which have not been supportive, turning supportive. You have valuation, with China tech was selling at a 50% discount to the US tech, which itself is selling at a 30% discount to where it was selling, 3 months ago. And it's not just the tech sector. Also, we own the A shares in our global multi-asset model. And the A shares too have acted quite well, and they look like they've bottomed as well. So I think when we think about China in the second half of the year, and now, we're in June, we should start really pushing out our view towards the second half of the year where we can, and starting into 2023. As soon as analysts come back from vacation, they're expected to have that out year forecast honed and start talking about the out year, which in this case is 2023. So yeah, we look at China and we see a pretty appealing story. And I would just note that year to date, EM is down about 18%. IFA is down about 20%, so non-US DM. S&P down 22, as I mentioned earlier, and NASDAQ down 30. So, China, EM is a big chunk of EM is obviously China. And so there, I think there is opportunity. We continue to feel that the opportunity space includes non-US equity, which we think is starting to take the leadership baton away from the US, which has held it from a global equity perspective for a decade. And when these transitions happen, these leadership transitions, they last for years. Yeah, they don't last for a couple months or a quarter or two. They last for years. And right now, when you look at policy mix, when you look at valuation, when you look at positioning, there's a lot to be said for the non-US markets.
And I think I mentioned in our last session, maybe the session before, our commodities analyst, he has a lot of contacts in China, and he did say that talking to some businessmen and in industries, the perception in China is that Xi has overdone with this nonsense. I mean, maybe they don't have a choice, but it's it's nonsense zero COVID strategy, and now they think that they have overdone, and they're desperate for growth. So they're desperate for growth, and let's see what they're going to do. And if one way to boost growth fast is through construction, real estate. So that's what he said. And then a few days later, there was this story that leaked, and we don't know. And then they corrected, and then they went back again about the re-IPO of Ant Financial. So it really looks like we're finding a bottom there.
Yeah, I mean, we agree. We're there. We're overweight equity. We also have positions in government debt. We have positions in Asian high yield, which have actually held up pretty well. It's kind of interesting. We have positions. We definitely prefer credit to sovereign. So we have positions in high yield, both in Asia and in the U.S. And we feel like we're compensated for the risk. Everyone loves to talk about, high yield and recession and defaults, and nobody's doing the work to recognize that all these companies refinanced over the last year. The amount of high yield debt in the United States that's coming due in the next 6 months is minuscule. Yeah. It's tiny. They've all refinanced. And again, people, just say recession, high yield, default, no thank you. As opposed to, okay, what does the default picture really look like? Most of it comes about when you have to refinance and you don't have access to the market. And the point that is different today is that all these companies refinanced over the last year. If you look at what's needed for the U.S. high yield market to refi over the next 6 to 12 months, it's minuscule. It's literally 2024 before there's any meaningful kind of mountain, refi mountain, as they call it, in high yield. And so it's really telling to me that there's just a lot of extrapolation. And in the meantime, if you take the other side of that, and so if you do the work, you realize there's no refinancing coming for a couple of years. So let me buy that when the spread is widened out to the most it's been outside of 2020, the most it's been in a decade. Let me buy that. I'm being compensated. It's painful because if the market moves en masse against you, then you're going to take a hit. But the reality should be that A, there's no refinancing, And B, by the way, there's no issuance either. So a high yield manager every month is getting dividends, and those dividends are piling up as cash, right, in their portfolio. And so that cash can be then used. Usually it's redeployed into IPOs or new financings. I guess not IPOs and credit, but new financings, right? There are no new financings. There's been no issuance in the U.S. high yield market for weeks and weeks. Same in Europe, same in Asia. No issuance whatsoever. In the interim, dividends are being paid. Cash is building up. That cash then can be used to support the existing positions. And that's why I think high yield has actually done pretty well, both in the U.S. and in Asia, believe it or not.
Yeah, and in Asia, we briefly touched on it, but I want to go back, because we've been in the market long enough, and in the 90s or so, the biggest widow maker was Japan, right?
The widowmaker
it has
trade,
cost,
sure.
Yeah, well, it has cost a lot of people's careers and and jobs, to say that Japan was going to blow up, and there were some people saying this, last week, with and then I think ended with what the BOJ did, and from my perspective, what's happened in Japan recently makes the investment case for Japan even better. But as you said, nobody listens. No one's paying attention to it. And is that still the case?
I would think so. We're overweight Japan. Japan has been a pretty good place to be, relatively speaking. It's down, obviously. Most things are, when the U.S. goes down 20-25%, everything's going to go down. That's no argument there. That's pretty straightforward. But in a relative basis, Japan's actually been a pretty good place to be. And by the way, with the yen at 135, Japan Inc., particularly if China starts to pick up and kind of does a dash for growth in the second half of the year, Japan's a huge beneficiary of that. And with the yen at 135, the companies are uber competitive. And so I think there's really room for positive earnings surprises in Japan. The economy's doing quite well, better than expected. The data coming out, the recent PMIs were better than expected. So Japan, to me, seems pretty appealing. And again, very few people are interested, but I think there's a fair bit of M&A taking place. I know there's a lot of private equity interest in Japan. There's a generational transfer of ownership in a lot of the Japanese companies. And so the folks in the PE firms in the US and in Europe are looking at Japan with a lot of interest to do M&A. So yeah, I think that's I think there's as we've talked about, non-US equity is interesting to us. We continue to think the commodity sector is interesting. We believe in a secular bull market in commodities. I would note that last week, the worst performing sector in the US was the energy sector, which had been the best performing sector year to date. It was down 17% last week, 17% for the energy sector. So, to me, that says we're getting close to the end of the sell-off because people are selling everything, even the stuff where they've been hiding, right? Everyone's been hiding out in energy.
Yeah, that's a great point,
And they sold it aggressively last week. So to me, that's another sign of we're getting closer to the end, the bottoming process that we talked about when we wrote about how the news doesn't have to get better, just less bad, or we wrote about the time to market versus the time to invest. All this stuff is kind of bottoming type behavior. But I actually took away from energy's big sell-off last week as a positive on kind of making another step towards the bottoming process. And if you're looking on a 1 to 2 year view, energy, that's an opportunity to buy energy. Same with Brazil. Brazil has been smoked the last couple of weeks. It's down 15%, one of the worst performing positions in our global multi-asset model month to date. But we still like it. We still think it's appealing. The currency is back to 5.12, I think I saw it today, or 5.15.
Yeah, today was 5.18. There were some political issues with Petrobras. Basically, what's happening is, and that's been going on for a while.
Yeah, political issues at Petrobras, man. You could write that story any point in the last 5 years.
This time is a different one. This time is a different one. This time is because and that happens in any democracy. That's the issue. We're talking about democracies before.
Yeah.
That high gasoline prices are bad for the incumbent.
Yep.
That's why Macron lost. That's why the socialists lost in Spain. It was also Colombia. It's a different story. But then there's been fighting between government and Petrobras as though they were not the same thing.
Yeah.
But that's what has been pressuring the currency, and that's going to die off in a few days.
Yeah, exactly. So buying the real at 518. With Brazil close to the end of its tightening cycle as opposed to the beginning. I mean, people are talking about debt implosions in EM, and I'm like, what are you talking about? In Brazil, the highest real rate pretty much of anywhere in the world. So I think Brazil, again, if you believe in a commodity bull market, if you believe that we're in a high nominal growth environment, as we do at TPW Advisory, Brazil epitomizes that, and it's an opportunity to reload or to build positions there when something like Brazil or the energy sector in the U.S. gets taken down by 15 or 20% in a week or two. That to me is that opportunity speaks.
No, it is absolutely. And so now, how do we go about the portfolio? And you mentioned you still basically non-US developed, but did anything change in the last couple of weeks?
Well, we update our models once a month. As you and the audience might recall, it's typically the first week of every month following our monthly. We publish our monthly, and then we do the model update the next week. So we haven't made any changes in the last week or two. Several weeks ago now, 3 weeks ago, the big move for us was to exit crypto. And thankfully we did, because we avoided this waterfall collapse in the crypto space over the last couple of weeks. So that was we probably should have done it months ago, but we've been gradually whittling it back, and we did exit completely in our global multi-asset model 3 weeks ago. But other than the non-US, the commodity space, the credit space, so talking equities, non-US, we continue to like value, continue to like the commodity space as expressed in equities. In fixed income, credit versus sovereign, high yield versus investment grade, and then so we've done credit and commodities. We still think it's a secular bull market. The fact that energy was sold aggressively is a signal of getting closer to the end of a sell-off than the beginning. And the other space that we should talk about, and we have not yet talked about, is in the innovation space.
That's a great idea. Yeah.
And that's an important component of our TPW 20 thematic model portfolio, which, by the way, every month is starting to show better performance. I mean, one of the values of having a model is to follow and see what's actually happening when you put it all together. And we ran the data late last week through Friday's close, and 10 of the 20 positions in the TPW 20 outperformed ACWI month to date. So that's ACWI. That's not even the innovation benchmark. That's ACWI. So that's a real good sign, because we've had some aggressive selling over the last couple of weeks, and half of the model has outperformed. Now, arguably, you say half has underperformed, and that would be true, but that compares to a couple months ago, only 2 or 3 of the 20 were outperforming ACWI, right? Because the thematic stuff was just being sold and sold and sold. And so to me, I think that space is bottoming. That makes perfect sense. The thematic space, the innovation space, was the first into the bear market in Q1 of 21. ARC, as we talked about, touched on it earlier, down 70-80%. If you look at a price to sales basis, it's now trading below where it was in the lows of March of 2020. It's trading back to levels of 2018. in terms of price to sales. At about ARC is trading right now at about 5 times sales. That's very compelling compared to the private market. In my view, the public market innovation space, the thematic space, is bottoming. The private market thematic and innovation space has a long way to go because it is way behind in the derating. And I just mentioned like Klarna, which is a European name. I'm sure you're familiar with it. Yeah, they're in talks for another round, and that round is going to be. I've seen references to suggest the next round is going to be down 50 to 70% from their last round on the private fundraising side. So private tech and private thematic, private innovation has a derating to go through itself. And I think this is important because it suggests that the public market innovation names and stocks and ETFs have a little bit of a protective moat around them, because the private space is going to be in disarray, no IPO exit, massive down rounds, massive layoffs, burn rate, trying to shrink the burn rate, extend the runway. That's all the talk in the VC PE space now. But that gives an opportunity to those publicly traded companies that are already out there to kind of continue to build market share and gain dominance in those different thematic segments or silos. So I look at ARK as the poster child, ARKK, the ETF, not ARK, the name, the family name. The ETF, that's one people can look at and follow. And by the way, it bottomed weeks and weeks ago. It has not made new lows over the last week or two. I think I mentioned earlier that NASDAQ made a new low last Thursday. ARK did not. ARK is a good 10 to 12% above the low of several weeks ago. So to me, watch that low, watch ARK carefully. It suggests that selling pressure is kind of ameliorating because it's been relentless for months and months and months and months. And the action on the derating side in the innovation space, I think, has now going to be taking place in the private market, not the public. And that supports the public market. So the way we're thinking about it is tactically, it's still the same story. We need to have some sign of inflation rolling over for Fed policy mistake risk to ease, which is recession risk ultimately, right? Because if inflation keeps going up, the Fed has to do more and more. That increases the likelihood of recession, increases the likelihood of earnings cuts, increases the likelihood of another leg down, right? If you cut off that at the top and get a positive dynamic going on the inflation front, housing lower, job growth slowing, gasoline, energy prices rolling over, all of a sudden you get a couple of inflation prints, you could be in a very different tactical situation where equities have a nice bounce, and perhaps more than a nice bounce. The strategic opportunity continues to be, as we see it, in that high nominal growth rate environment, which is meant to deal with the issues of COVID, climate, and conflict via a global capex boom. Companies have money, governments have money, consumers have money, everybody has money. That's something very different from 2008, very different from 2001. People and companies and governments have money at the moment. So a capex boom, which would be very beneficial for the innovation space in particular. The innovation space, the thematics around climate, around cyber, around fintech, et cetera, which have been just decimated, they would be the big winners in the new FANG type names of that high nominal growth rate environment that potentially we see out there in 2023 to 2025. The path to get there, admittedly, has become more challenging given the Fed action of last week and their language in particular. The pathway has gotten tougher, but the path is still there. It's still possible. And so, as we said, to kind of maybe recap, because I think we're probably getting close to the end, if we're watching that energy space very carefully, because that rollover of gasoline that we touched on and really went into in some depth a few minutes ago, if that happens, that sets off the tactical opportunity, which opens the door to the strategic opportunity. And in the interim, the innovation space we believe is bottoming. We believe non-US is bottoming. China is bottoming. Those are the areas of opportunity, together with the commodity space, which has had a big sell-off in the last week or so. And that's an opportunity to kind of reload in that space if you believe, as we do, that we're in a secular bull market for commodities.
Yeah, no, and this is great. I was actually going to ask a question on this, on the capex boom. Even if we, I mean, as you said, we have a narrow path, but even if we don't get there, is it an issue that, okay, if it doesn't happen in this cycle, it's going to be the next one, because the needs are there. We need to address, the climate and, and all of the story we've been talking about for 2 years. So if it's not in this cycle, this is going to happen at some point. So the story is going to come back, correct?
Yeah, I think the story is it's not an evergreen story, but it's a story that is intact. As we've talked about, climate is the single biggest global macro theme, because every country in the world is spending money on dealing with climate, and they're spending it in a tight time frame between 2020 and 2030. That's what makes climate that single biggest macro issue that we feel investors need to have exposure to. Riding through the ups and downs of the cycle is obviously been challenging, and more challenging than we might have thought, some 6 or 9 months ago, admittedly. But I think you're right that ultimately it's out there. But the way we're looking at it is, if we have a recession, that puts at least a stumbling block in between now and when we manifest that capex boom. If we don't have a recession, if we remember, slowing growth, which we have, is not slow growth, or is not recession, right? That's been our mantra for months and months and months. The risk is that the Fed freaks out because of the high headline inflation, the political pressure. Fed and central banks feel that pressure. Even if they're independent, they feel it. They're responding to it. So we need that headline stuff to roll over to give the central banks breathing room. If they don't get the breathing room, then they're going to do what everybody does when they're under pressure. They're going to lash out. They're going to make mistakes, and we're going to go into recession. And that recession makes it more difficult to see that pathway to that strategic opportunity of high nominal growth, because by definition, high nominal growth is real growth plus inflation. If the Fed is going to really grind down inflation, then you're not going to have high nominal growth. You're going to go back to pre-COVID levels of 2% real and 1 to 2% inflation for 4% nominal growth. To put it in context, Q1 in the US year over year, nominal growth was over 10%. Right? For this year, full year, we're expecting nominal growth of 6 to 8%. 2 to 3% growth, 3 to 4% inflation by the time we're exiting 2022. And so that's the difference that we're talking about, right? Going back to 4% nominal growth versus a period of 5 to 7% nominal growth with slightly higher inflation, solid growth, driven by the capex cycle to deal with the COVID climate and conflict risks, which we've all seen manifest in front of our faces over the last couple of years.
No, fantastic, and we just at the mark. So, as a final question, just to confirm, and so everyone knows, the space that people should watch, and to look for a big reversal in the market is the energy space, right? So that's what people should be focusing on. So if you have that rolling over, that's probably good news for the market, and especially for tech. Tech is going to grow through the roof if that happens, correct?
Well, I mean, to be a little more specific, the gasoline, what we're watching at least at TPW Advisory, is the gasoline price at the pump in the United States. That will send the signal that the headline inflation risk, which has really freaked the Fed out, is being brought back under control. And that reduces the risk of a Fed policy mistake, which reduces the risk of recession, reduces the risk of earnings cuts, and reduces the risk of another leg down. That's how we see the steps playing out. And it is pretty much that simple. Headline inflation rolls over, Fed risk goes down, rates go down, recession risk goes down, earnings risk goes down, potential for a better equity environment goes up.
Excellent. So yeah, this is great, you know, and we look forward to the next one, you know, 2 weeks from now. So thanks again, you know, thanks to our viewers, and you know, have a great, you know, rest of a week. Thanks again, Jay. It was always great to talk to you.
Likewise, Roberto. Thank you very much, and to
Thank you,
everyone,
sir.
thank you. Bye-bye.
Bye-bye.